What is the market telling me this week? Welcome to the Nick Rutherford Report, and the market is either going to take advantage of you or you are going to take advantage of the market. So hit that like button, subscribe to this channel, share this with someone who would get a lot out of it. I really appreciate it. This is a place to be for the financial news that matters for your net worth. Let's get to it. Google stock price is crashing. We got articles like this: the Google burst the generative AI bubble. That's what one analyst said. Well, other analysts at the same time are saying load up ahead of earnings, says top analyst about NVIDIA. What's the real answer? Well, we're going to look at the data, because Wall Street in general is always trying to take advantage of you. Buy, sell, freak out. That's what they're saying. That's what I'm hearing. Tells me nothing. Nothing at all. It's almost comical. So, other articles that I want to point out this week: shares of major French fry supplier crash as restaurant traffic slows down. And this goes along with the trends that I've been talking about every week. Part of the economy is doing good, while part of the economy is doing bad. In fact, Google is doing very good if you read the data, and we're going to get right into that. So it's very exciting to me when great stocks with great earnings that are continuing to grow go down, because maybe I'll buy some more. Not buying some right now, but we're going to get into the data here because we got articles like this: U.S. stocks slumped with sentiment pressured amid losses in Alphabet and Tesla post-earnings. Well, Google's not losing money. Yeah, the stock is losing. It's going down a little bit, but the earnings are great. So yeah, I don't really know how to explain when people write articles like this. And other articles that I'm watching that I find interesting: U.S. new home sales here are unexpectedly tumble in June as home buyer confidence crashes to a record low. And we've got articles like this: Florida housing downturn keeps getting worse and more intense. And this is something that I'm watching, but I'm also not freaking out about it because I'm not invested in Home Depot. I'm not invested in home builders. Home prices are very high. And if you look at the chart relative to income, they're incredibly high. And one of my principles for investing, what I believe in, is you need to buy low so that you can sell high. Most investors want to buy high and sell even higher. So I don't think it's a good idea for me to be buying into any of these things right now. So I don't have to worry about when they go down. I do have to worry if they go down enough and drag earnings down enough to make the entire economy go down, because one person's spending is another person's income, and they buy stuff, they spend, and corporate profits, and it all goes in a circle. So we have people who are making money, spending money to corporations, and stocks go up. And when that goes in reverse, things can be a big problem. But let's look at the data instead of the news to uncover what the market is really telling me. So what happens next, and what am I doing about it? Well, I'm reading the data. And one of the interesting pieces of data, a big macro overlay here, comes from Ryan on Twitter here with this graphic from Carson. And he says stocks have peaked in July only 3 times in history. I don't expect this to be number 4. So I'm only bringing this up as just a high-level probabilistic overview that stocks don't normally peak in July. So there's one piece of data. Is it relevant? I don't know, but it's unlikely to me that stocks are going to peak if earnings are going up, even if stocks are going down. So all I want to do is invest in trends, and I see the trends continuing. Here's a trend. This is why I bring up this piece of news. U.S. hits record electricity generation from natural gas. Guess what? We're using more gas. Remember, everyone said you were going to stop using gas and oil? And oil got to negative a few years ago. Well, when oil was negative, then it became unnegative, and yet the prices of the producers were still at the same price they were when oil was negative. I was backing up the truck on oil and gas stocks. We had the medicine for the plague, and I figured the economy would open again and people would continue to use oil. It was obviously at a low price, and then it would probably go higher. And those are the type of things that I like to invest in when it's so blindingly obvious that I can do the research and confidently deploy my money. I don't want to be chasing things when they're high with the hopes of they going even higher. I believe that the hard work will pay off and I'll get the result as long as I stick to my discipline. So let's look at more of the data to see what's really going on. Is it time to freak out? Well, Google's going down, down, down. Look at this chart from a month. Here it's down, down, down. You know, we were approaching 200 and now we're going way down. So it looks pretty bad. Is it time to freak out? This is almost comical because it's making me excited, not fearful. Because if I read the data, and maybe analysts just don't read the data, I don't even need to go too deep in the data to look at this. Like the quarter ending in 2023 was 74 billion and this is 84 billion. That's up 14%. Is Google going down or is it up? Well, the fundamentals are up. Let's look at their net income. Have they magically started losing money? Well, they were making 18 billion and now they're making 23 billion, assuming I'm reading that right and using the right billions. And, I mean, should I take a moment of pause? Like, read the data. The data is earnings are up and the stock is going down. Now, is now a good time to buy Google? I don't know. I don't have to make that decision because I maxed out my position on Google the other year. And fortunately for me, so I don't need to make that decision now. It doesn't look incredibly cheap, I can say that. But it's certainly not going out of business. And let's look at the price people are paying for it. 23 times earnings. Well, Google, if I look at this chart, is bouncing between 18 and 60 times earnings, roughly, just wildly roughly. So, you know, it's in the middle, on the low side of the middle. Does that mean it's cheap? I don't know. I don't need to make that decision. I'm not saying to invest in it. I'm only trying to point out that Wall Street is saying the AI boom is over. Oh my God, time to freak out. Yet if you take the time, the 30 seconds to read even the most basic of basic data, it is making more money. It's just completely wild. And that brings me to the next piece of data I want to point at. Guess what? GDP's up 2.8%. Are we having a recession when the entire economy is expanding? No, not today. Monday, when different data comes out and things change, yeah, maybe the market will tell me something different. But today, I can sleep like a baby because GDP is up, earnings are up, so I don't really care if a quality investment is going down. In fact, if it goes down enough, I'll buy more, and the market will tell me when to do that. But my whole point here is GDP's up. Like mic drop, end of story, don't really need to say anything else. This is the most important piece of data. But what is concerning that I do want to look at is here, the next piece of data. Bank of Canada cuts rates for the second consecutive month. And the reason I'm watching the rates is when the yield curve inverts, that's typically when we have a recession. And when we have a recession, earnings fall, and everyone freaks out, and the price of everything goes down. So you lose money relative to dollars or currency. And here we are. The yield curve is inverted. And what that means to me is very simple, the price of money. So when the price of money is more expensive in a shorter time frame, it's more risky, the higher yield it is relative to a longer time frame, and that causes the yield curve to invert. And this is typically a sign that there could be trouble. See, we'll just look at the past here real quick. And that is yield curve is inverted, uninverts recession. Yield curve is inverted, begins to uninvert recession. Yield curve is inverted, uninverts recession, and on, the same thing all the way every time. And it looks like history is repeating itself. Will it? I don't know. But I like to study the past to predict the future, and it's a pretty good indication that when this happens, it's time to be even more cautious. So right now, I'm just waiting to see what happens, watching employment, I'm watching the yield curve. Most importantly there, I'm watching GDP, and GDP's up. So let's move over to look at a few things on the market, because the market is up over the long time frame. Here I'm just looking at over the last 5 years it's up, over the last year it's up. Now, we're not experiencing something like this yet, where in 2022 it went down, 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 and the data looked bad. So then I was freaking out. But right now, it's been up, up, up. And yeah, this looks like a garden variety correction. Now, of course, it can materialize into something worse, and I can watch the data, and I can watch the speed of the market, and watch the acceleration and deceleration of it based on math. Yeah, I can watch that, and then I'll freak out if it reaches that level. But right now, like, GDP's up, earnings are up, so what if stocks are down? So what? Now, of course, things could change. And gold is up. It's near the all-time high. It's not at the highest high, but it's also not in a downtrend. You know what? Nvidia looks like it might be in a tiny downtrend, but so is Google, because maybe everyone's rotating into whatever Wall Street wants you to rotate into. That's what they've been saying. Everyone's rotating into small caps. Time to freak out. When I hear things like that, that just is someone telling me that they want to buy the stock that I have. They're like, oh, freak out, you better sell it to me. That's what I'm taking away from it. Now, of course, I could be wrong, and Nvidia could falter on its earnings, and I'll lose money when everything goes down. But if I'm a betting person, at least right now, seems like we're at the beginning of this AI trend. It's only been, like a year? And Nvidia was selling all their chips. They had back orders for their chips, and they've been growing like crazy, and Google's revenues are still up, so they're probably going to buy more chips. It doesn't make sense to me that this is the top and the world is ending. It just doesn't. Look at the data. Now, of course, some worse data could come out. If GDP was printing negative and unemployment was up and accelerating at the same rate that it did during past recessions, yeah, I would say, all right, the top is in, time to freak out. But I'm not seeing it yet. Nvidia is still way up on the year, but I think it's at 67 times price to earnings ratio, and it usually has been at 60, so it's probably a little overvalued. It's probably gone from incredibly expensive to super duper expensive, and it had to come down a little bit. And of course, all of Wall Street wants to say that the AI bubble is over, so maybe they want to buy your stock. I don't know. I'm not going to be right every time, but I don't see it in the data yet, and I don't see it in the market momentum. Now, next week I could change my opinion, but right now my opinion as of July 26th, not financial advice in any way, is I'm not worried. I mean, GDP's up, Google earnings are up, so what if the stock's down? That's my takeaway. I believe in research, I believe in looking at the fundamentals, couple that with market momentum. So a lot of people just want to trade off of news and market momentum, or worry. They want to worry off of momentum and market news. I only want to worry when the data corroborates the news and the market momentum, if that makes sense. I need confirming signals. I don't just want to take one signal and freak out and then sit around calling for the end of the world all the time. So let's look at Bitcoin here. Bitcoin's very volatile, yeah, but it's up. It's sideways. It's consolidated. I don't need to determine if I need to buy or sell Bitcoin here because I bought it during the FTX blowup. And now it's way up. And if you look at all the models, there are people who like to make models, usually Bitcoin halves, and then it goes up for a year and a half, and then it crashes. So right now it just went through the halving. So as I said before, one of my principles is study the past to predict the future. If supply goes down and everyone likes it, you like it, I like it, everyone likes it, we're all holding on to try to catch the top because everyone knows this. So you're going to have to trade off of other people's sentiment, or I'm trading for that I believe until it's more expensive. Because if more people want it and there's a limited supply, it's going to go up eventually. That's my thesis. At least until the facts change, and then I change my mind. So that's why I'm watching the market, to have the market tell me what to do. And right now it's telling me to do absolutely nothing because the fundamentals look good. The data looks good. So what if the momentum is slowed down and has gone a little negative? Now, if the data and the fundamentals start to turn down and the momentum is bad, then I'm going to freak out. But until I get all the confirming signals, the market is telling me to do nothing because I already made the decision a year and a half ago. I'm just saying because I don't remember off the top of my head. I'd have to pull it up. After the 22 sell-off, I'll bring the other chart back up. So over the timeline, the data looked bad, and I sold a lot back here at the beginning of 2022, and then I bought in all in this period here. I went all back in long. So I don't have to make the decision whether I should buy today. I'm already riding the wave, and if this is the top and I lose a little bit of money, it doesn't matter because I'm way up over the last year and a half if the data turns bad and I have to sell. But right now the data is looking good, so I'm riding the wave. Things are expanding. I'm using the fundamental analysis that I went through here. This is version light. I'm looking at the data. The data looks great. this is the punchline of this. I got to wrap this up. My wrap up is GDP is up. Google earnings are up. Like, things are looking great from that perspective. So the data is telling me not to worry. When the employment breaks, when or if the employment breaks, and when or if the yield curve inverts and the momentum turns down, then I'm going to freak out. That's what I'm watching for. I'm waiting for the market to tell me what to do or present a fantastic buying opportunity. Until then, I'm doing nothing. So subscribe to this channel. Leave me a comment. Comment money if you like money. Just the more comments and likes I get, the more this spreads so that I can get more subscribers. Then I'll do this even more in depth and I'll enjoy it even more and you'll get even more value out of it. So hit that like button, subscribe to this channel. It's Friday afternoon, so I'm going to go sit next to my pool. I'm going to drink some scotch and throw the tennis ball so my dog can go grab the tennis ball and just relax by the pool because I don't want to worry about the market. And actually, there's nothing to worry about because the data is good. So I hope you're doing well with your investments. Stick around next week. I'll come back on at the end of the week or come on sooner if there's something that the market is telling me that I need to do, and I'll talk about it. Until then, have a great weekend. Talk to you later. How am I using this information to protect and grow my wealth? Go to highreturnlowrisk.com.